Hey, what's up guys? Welcome back to the channel and I hope you're all doing well. In this video, I'm going to go over 5 different stocks that are my picks for the month from the hundreds of stocks that I've looked into that trade on the TSX. I'm going to cover the recent financial figures, talk about valuation metrics, and provide my analysis on why they are my picks for the month. Make sure you stay tuned for the entire video. I'm also going to provide recent business updates so you know exactly where these stocks are potentially headed next. Lots to talk about, let's jump right in. The first stock is Canadian Western Bank, ticker symbol CWB. CWB is an Edmonton-based regional bank that has made a successful push into Eastern Canada in recent years. And when you think of Canadian banks, you're likely thinking of big banks like RBC, TD, BMO, etc. But there's a lot of potential within Canada's regional banks exactly like CWB. Banks like CWB are a great pickup for investors, especially as interest rates are set to rise in 2022. And when interest rates go up, so do the profits for banks. Shares of this bank stock have gone up 30% year to date. That's an impressive run and one that I'm looking forward to seeing more of as we head into 2022. Let's break down the stats. Stock is currently trading around $36.65, has a market cap close to $3.2 billion, a dividend yield of 3.14%, and a 5-year dividend growth rate of 5.3%. In the last 1 year, the stock has gone up 19%. In the last 5 years alone, it is up 24%. And when you take a look at the analyst recommendations, 4 analysts have given this a buy rating with an overall buy rating of 2.5. This is a great pickup at the current trading price, especially when a stock with potential like CWB is trading below the lowest price target. This is a fantastic dividend stock with so much upside to come in 2022. In Q3 of 2021, CWB delivered total revenue growth of 16% to $263 million. Loans are up 9% to $32.3 billion. Branch raised deposits are up 17% to $18.7 billion. It posted adjusted earnings per share growth of 36%. We're seeing such fantastic numbers as the Canadian economy has bounced back nicely in 2021, especially after a rough 2020. The bank stock has a favorable PE ratio of 10 and a very strong dividend yield to go along with it. The rise in stock price and these stats show that the market is feeling more optimistic about the bank, especially after a few recent years of progress. And the EPS is expected to grow even further from an EPS of 3.1 to 4.5 on the high range by 2023. That's the type of growth you want for your portfolio, especially if you're a dividend growth investor. This reminds me of an old saying, share price follows earnings per share growth. And that makes EPS growth an attractive quality for any company. Unfortunately, Canadian Western Bank often flies under the radar because the big 6 banks are so much more popular than this supercharged regional bank. And there are many reasons to invest in CWB, and one of them is if you're looking for attractive, sustainable returns. It's a full-service bank focused on the unique financial needs of business owners. They've also zeroed in on key partnerships to deliver leading-edge technology without large investments. Here's a pro tip for all you investors out there. One way to double-check a company's growth is to take a look at how its revenues and earnings before interest and taxes, also known as EBIT, margins are changing. One important feature of Canadian Western Bank is that it is growing its profits. On top of that, we've seen insiders buying shares even though they already own plenty. To me, that all makes it well worth a spot on your watch list. By the way, if you're new to the channel or you've seen my content before, do me a huge favor, hit that like, subscribe, and thanks button because it lets me know to produce more content like this and you don't miss out on future stock picks. Next stock up is Enghouse Systems Limited, ticker symbol ENGH. As a key player in enterprise software solutions, ENGH is a Canadian growth stock that many investors may not have heard of. However, there are many reasons to like this company's growth prospects moving forward. After all, enterprise software solutions have become the foundation for remote work, chat, calls, and all the other online features we use on a daily basis. And in the wake of the pandemic, Enghouse has seen its business surge. Let's break down the stats. The stock is currently trading around $53.29 per share. It has a market cap close to $3 billion, has a dividend yield of 1.22%, and a 5-year dividend growth rate of 35.4%. That's a monster dividend growth rate. In the last year, the stock has been relatively flat, but in the last 5 years, the stock is up 102%. That's double the stock price in just 5 years alone. And taking a look at the analyst recommendations, you'll see why this is an easy pick as it has buy ratings across the board at a 2.2 buy rating. And the gravy on top, stock is currently trading below the lowest price target, meaning there's still plenty of upside given the current valuation. And given the rise of the recent South African variant, it's likely that we will once again shift focused to companies that are supporting the longer-term transition of remote and online work. And that's exactly why companies like ENGH are set to shine. Not only has this company grown organically, but also through a string of strong recent acquisitions. The company's cloud-based business provides impressive recurring revenues that investors like for obvious reasons. And at the current valuation, Enghouse is not even close to being overvalued like other tech stocks, especially looking at where the market is at right now. For growth investors, these are all big pluses. The company recently released its quarterly earnings, and investors will be excited to know that its cash flow position continues to be strong. A strong balance sheet is an essential factor to take into consideration for any company. And for tech companies as of late, valuations have gotten a bit out of control, so it's possible we may see a pullback. And finding companies that are trading at a fair valuation becomes even harder. And Enghouse right now is currently trading at around 22 times cash flow. With a stable debt load and the potential for cash flow growth to fund future acquisitions, this is a company with impressive upside right now. And just take a look at the recent acquisitions. It's not just a Canadian software company, it's a global software enterprise. And given the company's valuation compared to its peers and the potential for continued dividend hikes over time, this is a company definitely worth considering for your portfolio. Having said that, like all high-flying tech companies, Enghouse is a company that's certainly not without its risk. And right now, we're seeing a sell-off of risk assets, especially as the new variant is spreading across the globe. And this could really have an impact on economic growth that we've taken granted for the last few months. But for companies like Enghouse, this news is not a bad thing because it puts a focus back to online shift. In my opinion, Enghouse remains attractive from the perspective of a long-term investor. This is a growth stock I think deserves a worthy look, especially when you can buy it on major dips. Because if you have a stock in mind, why not pick up more shares when it's on sale? You know what's the best way to keep track of these amazing dividend stocks? You can download my custom-built dividend spreadsheet that I've developed personally for investors exactly like you. So you can keep track of your dividend income, your gains, your losses, and even forecast your future dividend income. I would not be able to manage and grow my portfolio without the spreadsheet. So make sure you check out the link in the description below to get yourself a copy. The next stock up is Granite Real Estate Investment Trust. Ticker symbol GRT.UN. There's a saying when it comes to investing in REITs lately, especially in the last 3 years: invest in beds and sheds, and this has worked well for investors as of late. What does that even mean, beds and sheds? Beds refers to residential real estate, while sheds is a reference to industrial space. Think of warehouses and fulfillment centers. The strategy works because no matter what the economic times are, people need somewhere to live, and the shift to online e-commerce has just made the demand for warehouses surge to insatiable levels. And the latter is exactly where Granite REIT comes into play. So let's break down the stats. It's currently trading around $100 per share, has a market cap close to $6.7 billion. It has a dividend yield of 2.96% and a 5-year dividend growth rate of 3.66%. In the last 1 year, the stock is up 33%. And in the last 5 years, the stock is up 133%, more than doubling the stock price. Taking a look at the analyst recommendations, this has a solid buy rating, with every analyst giving this a buy or a strong buy rating. Even though the current stock price is higher than the top price target, this is still a great buy considering you get exposure to a portfolio of global industrial properties. Industrial real estate has grown dramatically in recent years, all because of the shift to online retailing. Everything you buy online has to come from a warehouse, and because of COVID-19, that has only pushed and accelerated this trend. And during periods of rising interest rates, real estate tends to actually perform well because owners can pass on these rising costs as leases expire and they sign new leases. And many real estate companies have been extending their existing debt, taking advantage and locking in those ultra low interest rates. For investors who want income that can also be tax efficient, in my view, REITs are one of the best ways to generate passive income for your portfolio. You can become a passive landlord for global industrial properties and collect your rent checks on the monthly. Economies are improving and equity is relatively cheap to raise, which is why real estate companies are issuing more and more equity to fund acquisitions. Access and the cost of capital is as good as it has ever been, even with a slight uptick in global interest rates. In Q3 of 2021, Granite REIT saw its net operating income (NOI) rise to $84.5 million, which is up $76.5 million from last year, and it has consistently outperformed the TSX in the last 10 years. It's easy to understand the stellar performance as its properties are anchored by names like Amazon and Magna International. Its properties are infrastructure-like, meaning meaning that they are essential for the flow of commerce in society today. And that's why these properties command very long-term leases, around 6 years on average. This ensures very stable monthly income, not only for the REIT, but also for its investors. Today, Granite REIT is sitting at over 99% occupancy across its portfolio and has one of the best balance sheets in the industry. To me, that fact alone is why Granite REIT should at least have a spot on your watch list. It's done a fantastic job of growing its portfolio and raising its dividend. It has raised its dividend every year for the last 10 years, and that trend of growth is not stopping anytime soon. For a top income stock that you can rely on any business cycle, Granite REIT is a stock that you buy, hold, collect your monthly dividend income, and just forget about it and own it for a lifetime. Next stock up is Savaria Corporation, ticker symbol SIS. Savaria is a small cap company based out of Laval, Quebec, and provides accessibility solutions for the elderly and physically challenged people not only in Canada but also around the world. Many investors are not familiar with what small cap companies are, so let's define small cap companies first. Small cap companies are defined by those having a market capitalization between $300 million to $2 billion. These companies have a significant scope for expansion and can deliver superior returns in the long run. However, these companies are also riskier than large cap and mid cap stocks, as these companies are highly susceptible to market volatilities. If you're okay with a higher risk and longer term investment time frame, this company is definitely worth keeping on your radar. Let's break down the stats. Stock is currently trading around $18.67 a share, has a market cap of $1.2 billion, and a dividend yield of 2.68%. In the last 1 year, the stock is up 33%, and in the last 5 years, the stock is up 81%. And when you take a look at the analyst recommendations, this has buy ratings across the board from 6 different analysts, giving this a very solid buy rating of 2. And the best part is that the stock price is still well below the lowest price target, making this an exceptionally strong pickup at the current valuation. It has delivered strong quarterly performances, and the recent acquisition of Handicare has only increased investors' confidence, driving the stock price even higher. Savaria has also benefited from a rising aging population with increasing income levels and a very strong demand for accessibility solutions. The company is launching new products and solutions and expanding its geographical footprint to drive even more growth. In Q3 of 2021, Savaria delivered 2 times revenue growth of $180 million, while its adjusted EBITDA was up 55%. Based on a 10-year projected cash flow, the current fair value of Savaria is projected around $20.92 per share. Considering the stock is trading for less than $20 a share right now, it's trading at a 35% discount relative to its fair market value. Although the valuation of any company is an important factor, it should not be the only metric you look into when researching and doing your due diligence for any given company. Savaria is poised to benefit from the trend of an aging population. It generates sales in more than 40 countries with over 1,000 dealers and 15 manufacturing and distribution facilities across 12 countries. An important note here when it comes to valuation, here's the way you should approach a DCF valuation. Use it as a guide. What assumptions need to be true for a stock, any stock, to be overvalued or undervalued? So given the high growth prospects of Savaria, an attractive valuation, and a healthy dividend yield, that's exactly why I'm bullish on this company. Last stock up is a TMX group, ticker symbol X. Given how the Toronto Stock Exchange, the TSX, has performed over the last few years, its operator is also a very viable investment. Canada's senior equities market is one of the 4 operating segments of the TMX group. The TSX and the Toronto Venture Exchange, TSXV, belong to the TMX Capital Formation segment. So what does this jargon really mean? It means that you can be an owner of the TSX and the TSXV by investing directly in the TMX group. Taking a look at the stats, it's currently trading around $123.93, has a market cap over $7 billion, a dividend yield of 2.45%, and a 5-year dividend growth rate of 12.08%. In the last 1 year, the stock performance has been consistent, but in the last 5 years, the stock is up 81%, meaning almost doubling of the stock price. The TMX has a very solid buy rating at 2.7, especially when you consider it's trading below its lowest price target. You can, in theory, pick up the stock while it's undervalued and hold for the upside. A quick thought here. Why do companies even list on any public exchange? Companies that list on any global exchange gain a level of prestige and access to equity capital that enhances their liquidity, thus making it attractive to a global base of investors. Besides capital formation, TMX also operates global solutions, insight and analytics, derivatives trading, equities, and fixed income trading. As more and more companies seek public equities, there is a tremendous growth opportunities for the TMX group to grow right alongside. In September of 2019, TMX launched the the TSX 30 program. This is a flagship program that ranks the top 30 performers on the TSX. It showcases mostly growth stocks and growth-oriented companies. What's really interesting about this program is that 37% of the companies listed on the TSX 30 are graduates of the Toronto Venture Exchange. In August of 2021, TMX acquired ASD Canada to augment TSX Trust service offering. And in September of 2021, the Montreal Exchange launched derivatives trading on Asia Pacific time. With recent acquisitions and expansions, the TMX Group continues to diversify its revenue streams, at the same time increasing its proportion of recurring revenue. All of this is exactly what investors love to see. The financial sector itself has many different industries, like banking and insurance, and each has its selection of giants as well as underdogs. But the TMX Group is a one-of-a-kind financial stock, at least on the TSX. Why? Because it owns the TSX. In a nutshell, the TMX Group is responsible for operating market exchanges, which includes the TSX, which is Canada's premier stock exchange. Its underlying companies also includes the Venture Capital Exchange, Montreal Exchange, and the TSX Alpha Exchange. This is a stable company that offers a combination of capital appreciation and dividend growth. Did I miss a stock that should have been on the list? Let me know in the comments. And make sure you check out my entire series of various dividend stock picks that I've covered in the past. Thank you so much for watching. Links to everything I've talked about and more are in the description. And I'll talk to you in the comment section.